Okay, it looks like we're ready to begin. Good evening, everyone. My name is Hadra Hassan. I'm a certified financial planner and advisor at TMFD Financial. I'd like to start off by thanking you for joining the webinar this evening. And in a moment, I'll introduce our presenter, Nicola Elkins. First, I'd briefly like to introduce TMFD Financial and explain the valuable services we provide to our clients. Our goal is to make financial lives of dentists simpler by combining a variety of services under one roof, from tax, investments, insurance, and other financial planning matters. We also coordinate with external professionals that you may need over time. These are lawyers, mortgage brokers, bankers, and this is to ensure all your current and future financial needs are covered. In our experience, we've found that providing these resources under one roof, it gives you the comfort of knowing that all your finances are coordinated. The result, simplicity, peace of mind, and confidence in your financial decisions. In addition, TMFD Dental Academy hosts webinars such as this one to enhance both your clinical knowledge and your knowledge of wealth management. At this point, I'd like to turn things over to my colleague, Aaron Carbello, who's managing the technology, and he'll go over some housekeeping items.
Thank you, Hadra. For those unfamiliar with Zoom webinars, if you have any questions for Nicola or Hadra, please utilize the Q&A button found at the bottom of your screen or device, and we will be able to address them as they come in. Alternatively, there is an option to raise your hand if you would prefer to be called upon. And lastly, there is a chat button at the very bottom of your screen as well, which allows you to communicate with everybody attending this webinar or directly with the hosts and panelists. In regard to CE credits, they will be sent out within the next 2 weeks. Back to you, Hadra.
Thanks, Aaron. I'm pleased to introduce our speaker this evening, Nicola Elkins. Nicola is the president of Cost Strategies, Inc., the charitable wealth management solution provider for Benefaction. She's also the founder and CEO of Benefaction Foundation. She's built a reputation as a valuable resource for those who want to integrate charitable giving into their clients' financial, estate, and succession plans. Prior to establishing Cost Strategies, Nicola spent 20 years in the financial services industry, holding several senior roles. She has a Master's of Science from the London School of Economics and a BA from McGill University. She's the managing editor of Master Financial Advisor philanthropy course offered by the Knowledge Bureau. She's also the past president of Rotary Club of Westmount and of La Manoir, a home for independent seniors living in Westmount. Please join me in welcoming Nicola.
Thank you, Hadra. Good evening, everyone. It's my pleasure to be here. I'm honored to have been invited to talk to you about something that I'm very passionate about, which is charitable giving. We have a lineup today of a number of things that we want to cover. So firstly, I'll tell you a little bit more about myself and the organization, Benefaction Foundation, that I represent. We'll do a little overview of trends in charitable giving in Canada, and we'll talk about some of the challenges that you as Canadians have to your wealth. And I have a number of scenarios to share with you about ways to give strategically, and we'll talk about what that means. And often my world is in donor advised funds, and I'll tell you more about what they are if you're not already familiar. But we are often compared and contrasted to private foundations. And so we'll talk to the differences between those two types of charitable giving vehicles. So that's our agenda. To start with, Benefaction Foundation, we are a national charitable public foundation, and our mandate is to help affluent Canadians and their financial advisors harness the advantages of strategic giving. So for us as a charitable foundation, and more than 90% of our revenue comes as a direct result of an introduction or from a wealth management professional or estate planning professional's influence in discussing these options with their clients. So we really recognize the importance of having and creating and maintaining relationships with the professional advisor community, which is part of the reason, I guess, that I was invited to talk to you. So we believe that we've built a valuable reputation as a resource for investment, legal, tax advisors who want to obtain a more comprehensive knowledge of how charitable giving can be integrated into their clients' overall wealth management plans. So just to give you an idea of my team, this is not in fact the entire team, because we've just hired another lady. We are all ladies, unusually. I founded this organization in 2008, and at present we manage over 1,000 DAFs, so that's over 1,000 principal donors plus many other donors into those funds, and we have long-term charitable assets in excess of $450 million. So we've grown quite big, which I'm pleased to say. And one of the reasons that we've grown as large as we have is that Canadians are very generous. Affluent Canadians are becoming more philanthropic. And in 2020, they gave over $10.6 billion. And this number has been trending upwards. In fact, it's been trending upwards since 1995. So there's a long history of essentially unprecedented growth in this sector. And there are lots of factors that are coming together, I think, that are sort of leading to that, or part of the impetus of that. And that's demography. We're getting older. Older people give more. Wealth. There's a big transition of wealth going on with older business owners and just older baby boomers transitioning their wealth to their families. Legislation, which is positive in terms of providing us with incentives to make donations, and just societal trends, GoFundMe and other philanthropic trends in our society. They all point towards a continuation, I think, at least for the foreseeable future, of a continued growth in philanthropy. So it's not all a rosy picture, however. There are some troubling trends. While the average donation size of tax filers is growing, the number of donors as a percentage of tax filers is trending downwards. And as you can see from this slide, it has been for a number of years. So that is disturbing. It's, I guess, evidence that many people are finding it tougher to be able to make donations, but it's also evidence that those Canadians that do give are giving considerably more. So that's part of our focus at Benefaction Foundation. And some more evidence in that regard comes down to an analysis of incomes. So this slide represents donations by income. And despite the reducing number of donors that I've just mentioned, the donation receipt totals continue to rise. And specifically, that is driven by high net worth and high income donors. They are the drivers of this change. So on this slide, the blue bar represents the percentage of tax returns in each income category. So if you look to the right, you can see the much mentioned 1%ers. 1% of Canadians make in excess of $250,000 a year. And those people are one of the most generous in terms of the percentage of donations given, shown by the red bar. And if you combine the incomes of everyone over $100,000, which is still a significant level of income, those three categories make up only 9% of tax filers, but over 50% of all donations in Canada. So that's a significant fact in terms of what's happening in our industry as well. And as I said at the outset, our organization is very much focused on donor advised funds, and we'll get into that a little later. But donor advised funds in and of themselves are an investment vehicle. It's one of the fastest growing types of charitable giving vehicle in Canada. And this slide is just representing the growth over the last few years that we have numbers for, which have been significant. Donor advised funds were only started in about 2008, I think was the first one launched by the TD, Private Giving Foundation. And so we have come quite a long way in that short period of time. So total assets held in donor advised funds at the ends of 2021 were $8.5 million. So that represents an average fund size of $406,000. And it's estimated that 10% of all donations in Canada came into the charitable sector through donor advised funds. Donation flows into DAFs in 2021 were 2.2 billion. So of the total that was donated, 2.2 or 10% almost of that money went into donor advised funds, which is a considerable jump from the previous year. So that's really it for the sort of the Canadian overview. One of the things that we wanted to talk to you about as potential donors is some of the challenges that you might be that you have or you might have in regard to your wealth. So the first challenge, I think, is something that's this slide is courtesy of a friend of mine from Toronto who's a financial advisor, and he uses this traffic light analogy to describe asset classes in respect of taxes. First, there are green assets. So, for example, your home, none of the gain is taxed when you sell your principal residence, as you know. And then there are yellow assets. Yellow assets are taxed at 50% on the dollar. So the capital gain portion of your stock portfolio is taxed at 50% when you sell it or when you pass away. And then lastly, there are registered assets. And these are one of the worst ways to transfer dollars to your beneficiaries. And don't get me wrong, they are an unbelievably great way to build your wealth. But because they are taxed at 100% upon your death, they often create a major challenge in terms of the tax bill associated with that. So that's one challenge in regard to wealth. And the other is that, you know, many of us in Canada are private business owners, and or even if we're not, we are, it seems, according to research, failing to pass on our wealth and preserve it from generation to generation. And that is something that is unfortunate, I think, and it's something that concerns a lot of the donors that we speak to, and is part of the whole estate planning, wealth preservation, and legacy planning discussion that we often have with advisors and with donors. Another major factor or challenge is concerns that wealthy Canadians have about how much money should I leave my children and my heirs? I mean, am I going to hurt them by leaving, for the super wealthy people, or am I going to hurt them by leaving too much? And you are probably aware of a number of very wealthy individuals who have left millions, if not billions, and an increasing number of them, I would say, are of the same mindset as Warren Buffett here, who said that parents should leave their children enough money so that they would feel that they could do anything, but not so much that they could do nothing. So that's a common sentiment amongst donors that we talk to who are lucky enough to be in that category. And then the other big question and a challenge for people who are considering giving money away is how much do you leave? How much do you leave to your heirs and your beneficiaries? And it's a really challenging question to answer because it depends on everybody's individual circumstances, of course. The good news is that your financial advisors are in a great position to help you to work out how much you can afford to invest in your community and put your wealth to good use while making sure that you've taken care of your lifestyle throughout your lifetime. Some experts say or suggest that people should start at 1% of gross income or up to 3% for the very wealthy. There are many Canadian organizations trying to push that number up. So, it really depends, as I said, individually. But those are a number of factors that are at play in terms of challenges for people who are wealthy enough to consider major charitable gifts. So the next portion of my presentation is really about donor advised funds and trying to help to give you information on what they are, how they work, and when they might be appropriate for you. So, as I said, a donor advised fund is a charitable investment account sponsored by an independent public charity like Benefaction Foundation. We're, of course, not the only ones. There are many others that provide these services. And it can receive donations from one or many individuals. Donors get to name their own fund. And I always say that it's like having your own private foundation without the accompanying cost and administration associated with it. So to kick this portion off, we have recently developed a video. And it's just a couple of minutes. I'm going to show you that short video, which kind of explains what donor advised funds are. And then I'll try and elaborate on that a little bit more. So bear with me while I share this.
Having the means to live well is important. Making a meaningful difference is life-changing. Benefaction can help you achieve both goals. A donor-advised fund with Benefaction can help you reduce your taxes and administrative burdens while maximizing your impact on the causes you care about most. Here's how it works. Your advisor helps you establish your own fund with an initial gift of $25,000 or more in the form of cash, publicly listed securities, private company shares, or life insurance policies. You choose a name for your fund, what personal details, if any, will be shared with charities you support, and you can name successors to manage your fund after you are gone. You receive a donation receipt for your gift, which may be used to reduce your income tax. Your advisor can help make sure you donate wisely, such as by taking advantage of unrealized capital gains in your portfolio to increase your tax savings. The money is invested into a separate account with a balanced portfolio that grows tax-free, making your gift more valuable. With continued growth, your fund can create a charitable legacy in your name that lasts for generations. A portion of your fund is granted to registered Canadian charities each year. You recommend who receives grants from your fund, and Benefaction takes care of the rest. It's simple. Give a tax-advantaged gift, grow its value over time, and recommend grants to charities that matter to you. Benefaction offers the ultimate flexibility with your granting. The organizations you support, how much you give, and when can change each year. A fund from Benefaction combines intelligent tax planning with charitable giving. It's all about helping you live well and make a meaningful difference. To find out more, please speak to your investment advisor or contact Benefaction directly. Having the means to live.
Sorry about that. So that's our new video, and it'll be posted on our website soon. But to elaborate on what a donor advised fund is and how it works, I like the video, explain it in 3 steps. The first is the gift. In this case, a client starts off with an initial donation. They will sign a donor agreement with the foundation, and they will determine whether they will fund it with cash or public securities or other types of investments, which we'll talk about. And then upon donation of that account, of that gift, benefaction will issue a tax receipt, of course, which you can use to help reduce your tax burden. The next step is to grow that investment. So we then partner with your investment advisor, and your donation is monetized and invested by Benefaction Foundation in a separate account for your specific donor advised fund, with a long-term objective to grow capital, of course, and it'll be growing tax-free because it's now owned by the foundation. And then the third step, as the video presented, is that each year you will be able to grant out a portion of that fund to any Canadian charity that you choose. So you can decide which organizations will receive your gifts. Benefaction has to technically approve those grant recommendations, we call them, and then we take care of the administration to make the grants out to the charity of your choice. This is a summary of the gifts that we accept at Benefaction Foundation. Obviously, cash is always king for charitable organizations until 2007, when the government made gifts of publicly traded securities very attractive, because they allowed individuals to donate in kind publicly traded securities, and thereby eliminate any capital gains tax that they would otherwise have to pay in making the donation. So we'll talk about the advantages of that again in a minute. We also have accepted a number of private company shares, and we have an example of that to share with you as well. Private company shares don't enjoy the same zero capital gains tax exemption rules as publicly traded donations do, but nonetheless they can be advantageous. We accept registered plans that we are either made beneficiary of or donated to during someone's lifetime. Gifts of life insurance are increasingly common with our organization, and of course, estate donations when people pass away. All of these are the kinds of gifts that we currently accept. So generally speaking, not real estate or gifts of art. That's not our area of expertise, but nonetheless, quite a number of a vast array of gifts, and some of them being complex ones. So in terms of the granting part, once you've set up your fund and it's been invested by your advisor, each year you're going to want to make charitable grants out of that fund. And this slide is just a summary of who we can issue grants to. And when I say we, I don't just mean Benefaction Foundation. I mean any public or private foundation has certain restrictions. We have to gift to qualified donees. Qualified donees vastly are made up of the listed charities inside Canada that are registered with CRA. There are over 86,000 of those. So that's the vast majority of the qualified donee list. But there are a number of other organizations, amateur athletic associations, various levels of government. There is a prescribed list of universities or schedule of universities that are outside of Canada that we are allowed to donate to. So many people can grant to their alma mater if they went to school overseas. There are some national arts organizations, and generally speaking, those are the entities to which grants can be made from a fund at Benefaction Foundation or at other charities. The disbursement quota is the amount of money that can be, that in fact must be dispersed from these types of funds every year. And this year, interestingly, that number has gone up, and we'll talk about why that is in a little while. But last year, until the December of last year, the DQ, we call it, or disbursement quota, was 3.5% of basically a rolling average value of the fund has to be dispersed every year. Excuse me. And as of January of this year, that number has increased to 5%. And in addition to that, some of the charities that we are able to disperse to have been expanded beyond the qualified donee list that I've just talked to you about, but also to some other non-qualified donees and not-for-profit organizations. In all honesty, the sort of jury is still out on what that means, because the government haven't provided us in the charitable industry with specific guidelines yet as to what we would have to do to be able to grant out to a non-qualified donee, like a not-for-profit, like Black Lives Matter or other organizations, you know, Indigenous nations that have not yet been registered under CRA's qualified donee status, that kind of thing. So it'll be very interesting to see what happens there. But the climate in our industry and sort of some key things that you should know about is that this new budget that has come out most recently has proposed some changes to what is called the alternative minimum tax for high income earners, where they propose to make changes that may cause high income individuals to unfortunately reconsider some of their charitable giving plans. And that is because while they brought in many welcome changes, as I've mentioned, there are some other important proposed changes that people should be aware of. This is targeted at high net worth and high income individuals who donate publicly listed securities. For context, the federal alternative minimum tax is an alternative tax to regular income that is computed without the use of many of the deductions and credits that would otherwise be made available. And so some in certain circumstances for some individuals, some of those credits that we're going to talk about and the examples that I'll share with you will potentially be reduced. And so, you know, we're still waiting for some scenarios and examples from financial and legal professionals to help us understand that more, but that is something that's relatively new that you should be aware of. I've already talked to you about the increase of the disbursement quota. That's part of really a result of the government and a recent Senate committee being concerned that private foundations and public foundations and the donor advised fund foundations, of which we are part, were sitting on their assets and not distributing them out to charitable organizations. And so as a result, one of the moves of the government was to increase that. That is simply something that Benefaction applaud. We are all for getting more money out into the hands of charitable organizations. In fact, we require that every fund that is within our remit disperse its minimum every year. That isn't necessarily a requirement of all organizations, but we require it. Some individuals have felt that donor advised funds enable individuals to divert capital from directly to charities while still getting their tax receipt. This we believe is a misperception. There's no evidence that dollars donated into a DAF would have otherwise gone directly to charity. And others have said that donor advised funds are an overhead and there's an intermediary. But I think you'll see as I take you through some of the examples that there are significant benefits and that are being embraced by Canadians who are making this vehicle the fastest growing charitable vehicle in the country.
Hi, Nicola. We have a question for you.
Sure.
Someone is asking how much the administration fee is for the plan.
So with donor advised funds vary from foundation to foundation. At benefaction, we have two levels of fee. It's a 1% fee right off the top based on for donations of $1 million or less, 1% up front. And then in addition to that, we have an annual administration fee of 50 basis points. So that is the fee. There's no fees for making grants or anything like that. Just those two, the combination of those two things is the benefaction charge. In addition to that, whatever is paid to your investment advisor who will be managing the account is also a cost consideration for the fund.
Super, thank you.
Okay. So back to the benefits of establishing donor advised funds. Obviously, there's the tax savings because you'll get a charitable donation receipt when you make the initial donation, which will help you to reduce your tax liabilities. Many people like them because they're efficient. You have all the financial advantages establishing something that is like a private foundation, but with significantly less cost and complexity. You have control to the extent that you have control over which charities you may make gifts to, without and you can be kept informed directly from those charities about the impact and the good works that they are doing. So you definitely have control over which charities are going to receive the gifts from your fund. And you have the opportunity to create a legacy, a lifetime legacy, really, and involve your family and heirs into building something that you can look at later and say, this is something that my values help me build. And you can make donations to it now during your lifetime, and also, as I mentioned, and we'll talk about again, donating other assets as well, both now and later when you pass. So in terms of the drivers of major donations, they're driven by a couple of factors. So what motivates many people to give is charitable intent. That's first and foremost. And without that, nothing usually follows. But if you are someone who is interested in making a charitable donation or make charitable donations every year, then you might be inclined to think about leaving a sizable bequest in your will if you have additional funds over and above what you and your heirs need. So there are both personal and taxable events that are associated with major donations and giving. Personal events like retirement, estate planning, the loss of a loved one, unfortunately, is often one of the reasons why we are receiving new donor advised fund agreements. And of course, inheritance, when you have a windfall of some sort. But also importantly, taxable events. So when people sell their business, they, many Canadians are business owners, and they will have the largest tax hit of their lifetime during that year. Employees who have stock options, they have significant benefits through employee stock option gifting as well, similar to publicly traded securities. Sale of property and deemed disposition. All of these events translate into, often for us in the charitable community, a significant major donation. So what are some of the reasons that people consider setting up these donor advised funds? Well, research tells us that people like the idea of being able to invest and grow their charitable assets over time so they can leave a bigger impact later. And they like being able to be better organized and keep a better record of their giving. So with a donor advised fund, you make one donation, you get one tax receipt for your for your tax return, but you can give to many different organizations through that one vehicle. And so it's sometimes considered simpler. And another significant factor for me is it gives donors time to decide where to give. I mean, if I go back to the example of the business owner, in the year that you sell your business, you've got many, many things on your plate, and making a decision about setting up a private foundation and exactly which charities you want to give money to, if you choose that that's what you're going to do, is not necessarily first and foremost in your mind. A donor advised fund is a great way to be able to ensure that you've been able to help to minimize your taxes by making that charitable gift. But you don't have to make the decision about exactly which organizations and over what time period they're going to receive those gifts. And so many of the donors that we speak to are very pleased about that element of what donor advised funds can offer. And there are a number of other things that that donor advised funds are liked for. Just a couple more things on this, and then we'll get into some more examples, some of the gift scenarios. We have
Nicola?
a new foundation portal. Yes.
There's another question.
Okay.
Can the advisory fund donate to non-Canadian charities?
Well, the Income Tax Act does not allow for charities outside of Canada to receive donations from Canadian foundations, except under certain circumstances. So if a private foundation wants to set up a special arrangement with an international organization and does a lot of what is called direction and control, books and record keeping, and have contracts in place and quite a great deal of reporting, then it is possible to do so. Or if you have an entity that is a Canadian affiliate of an international organization, then we can, as a foundation, definitely make donations and ask for direction of that money to a specific region or area or program. But the government doesn't make it super easy to do that. We do have a couple of affiliated internationally focused foundations that we have on occasion partnered with that can and do make international gifts. Those organizations, however, they do charge an additional amount based on the grant that goes from our foundation through them to the international entity. And likewise, just with if you're doing it yourself as a charitable foundation, there's quite a bit of documentation and record keeping that's required to go with it. So it is possible, but it's not always easy, I guess, is the short answer to that question.
Thank you. One additional question.
Mhm.
What happens when a donor doesn't have family who can manage after their death? Can they pick charities during their lifetime that can be carried on? What's your general process for that?
Yes, so donors can pick charities during their lifetime. And if they don't have someone that they want to name to succeed them as the recommender or, to take the place of the donor, then the benefactions board's default is to continue annually to make donations to the same charities or like charities that the donor had made during their lifetime. So there are those options. Other people will establish with us what we call a gift plan, where they give us specific instructions. So in the event of my death, these are the charities that I want you to give donations to. And whilst it can be ongoing every year for as long as the gift fund continues to have dollars in it. You can also make recommendations to disperse significant portions of your fund at that time if you wish to. But otherwise, we would always continue to grant out to the charities that you had previously named.
Perfect, thank you.
Okay. So last couple of things on this and on us is we have a new donor portal, which was launched last year, where donors who work with us can get a snapshot of their philanthropic activity, get access to their key documents like their previous month statements, as well as all their tax receipts. And they can make online grant recommendations so that they can log into their portal, select their charity of choice, tell us how much they want to donate, and send us an online request. So this is a work in progress for us because it's brand new, but we're very pleased to be able to offer it to donors, and our uptake has been quite significant. So and we send out quarterly reports to our donors as well. This is a summary of the current donor report. It's also being revised. In fact, this year we're going to be establishing a bigger, better version of this. But essentially, it just tells you a financial snapshot, gives you an idea of how much money you've donated since inception and how much you've granted out. We disclose our fees, of course, and let you know how many grants you've made over that current financial period. We summarize the disbursement quota that I talked about for your fund, how much it is, how much you've given this year so far, and what's left to go out. And any donations that were made during that period into the fund, and any grants made from the fund during that period are also listed on your quarterly statement. Plus, we have this this pie chart of charities that you've supported since inception. So you get an idea by sector who you're happy to support. So next, I did say at the outset that we would talk about private foundations versus donor advised funds, and when is it appropriate for one to consider a private foundation versus a donor advised fund. It has to be said that for those donors that want total control over investment decisions, granting, and administration, a private foundation is the way to go, because they will not be subject to the investment policy of the sponsoring charity. However, setting up a private foundation, it's a lot of work, and it requires that you establish a trust or a corporation, that you create bylaws, you have to have a board, and you have to hold regular meetings. You have to minute those meetings, and you have to keep a proper book of record and resolutions of the meetings and what have you. And then on an ongoing basis, you have to continue to keep those books and records for all donations in and grants out and expenses, and fulfill a tax filing, which is called a T3010. You have to issue donation receipts and under CRA guidelines, and you have to select grant recipients because you have to meet that disbursement quota that I talked about before. Plus, there are lots of complex rules around private foundations, about non-qualifying security rules and excess business holding regime rules, which are really in place to ensure that there's no advantage being given to the people who are setting up the private foundations. So comparatively, donor advised funds have a lower barrier to entry. Their costs are usually considerably lower. They're very quick to set up. And they also provide privacy to a donor that they often don't get if they set up their own private foundation, because all foundations, public and private, have to post all grants and all donations received on Canada Revenue Agency's Charities Directorate website. So for people who are private and want to keep their giving to themselves, a private foundation is not always so private. And also I talked before about the differences in cost and this slide, and you'll be able to get copies and access to these slides as sort of a summary of different asset levels of benefaction funds versus a private foundation. And they're all pretty large in terms of the comparisons, because professionals will tell you that, unless you've got a few $1,000,000, setting up a private foundation probably isn't necessarily worth it for you, just because of the cost and the time commitment that you'll have. But, how do you make the choice? How much time are you prepared to manage and administer a private foundation? Are you sensitive to fees and costs of doing so? Do you want full and total control over what is happening in that foundation, or are you willing to relinquish some of that in order to direct grants to specific charities? Do you need an immediate tax receipt? Do you have a taxable event that you have to make a donation now and you haven't got your private foundation set up yet? And also what assets are being donated. As I mentioned, private foundations that are tied to individuals with a private company that's maybe a donor, they need to be careful to watch those rules. So we're going to move on now to some gifting scenarios. And what I'm doing here is I'm sharing with you some of the popular and some of the more complex and less used, but sometimes more interesting types of gifts that we have been involved in. I have to fully disclose to you that I am qualified to run a charity, and that's what I do. I am not a financial advisor. I am not a tax advisor. I'm going to discuss some elements of financial instruments and tax benefits, but you really need to speak to your own professional advisors if you ever were to consider doing any of these things, because I'm really just here to share some information with you about the kinds of gifts that we accept. So, disclosure and disclaimer aside, gifts of securities versus cash. So for donors who hold highly appreciated securities, there are favorable tax incentives to donate in securities in kind instead of taking stock from their investment portfolio, selling it, and donating cash. And this table clearly sort of points out, based on an example of a $100,000 donation with a capital gain of $90,000, that the after-tax cost of donating stock versus cash is significantly different. In this particular example, if you donate in kind, your after-tax cost is going to be $53,600 from that $100,000 donation versus $74,480 if you sold the stock and donated the cash. So if you're ever considering making a donation and you have an investment portfolio with highly appreciated securities, you might consider first selecting some of those appreciated securities and making a donation of those. There are some limits. There's an annual contribution limit for gifts in kind, which is 75% of your annual net income. However, the excess of that, if you do gift more than that amount, can be carried forward for a further 5 years. So that's 6 years, the year of the gift, and years thereafter, 5 years thereafter. And it's just a more tax effective way to make still a substantial and effective charitable donation. Another common way to give is to give a bequest or a charitable gift in your will. There are a number of different types of bequests. There's a specific bequest where you name a specific piece of property or an amount that can be paid out before the residual of your estate is distributed. There are restricted gifts that stipulate that funds should be used for a specific purpose. There are residual gifts. There are contingent gifts that deal with disaster clauses. But I mean, suffice it to say that a charitable gift in your will not only enables you to be able to give back to your community or the charities that were important to you, but it does help in terms of offsetting some of the income tax payable at the deemed disposition upon your death. So it's definitely something that charitably inclined individuals, particularly those that are dealing with their estate planning and the revisions of their wills, should be talking to their investment tax and legal advisors about. Another strategy that's often used with us is gifts of life insurance. Life insurance sometimes enables you to supercharge the size of the gift that you might want to leave. But in this case, if we consider maybe that, many Canadians have gifts of RRSPs, for example, and RIFs. I talked about the tax consequences of those earlier, which is great for retirement. But as I said, one of the worst ways to pass money on to their heirs because they're taxed at 100%. But naming a charity as the beneficiary of a plan usually eliminates the tax on this investment. Upon death, the proceeds go to the charity and the estate receives the tax credit. They're referred to as designated donations. But if the donor is insurable and takes a policy to replace the plan value for the estate, the strategy provides the funds to pay the tax that's otherwise going to be owing on your death, and without depleting the value of your estate that's going to your family, and you still get the opportunity to make a significant gift to the charity of your choice. So these kinds of packages of gifts of registered plans coupled with life insurance are good for any donor that has a registered plan that's not really needed any longer. They want to make a charitable donation, they're insurable. In this case, as I said, they'll name the charity as beneficiary of the plan. The gift, therefore, doesn't pass through the will and probate costs are avoided. The charity receives the gift and issues a tax receipt. And if the insurance is the equivalent value, then, as I said, the estate can be restored to its pre-tax level. So lots of benefits for donors in terms of reducing taxes on their estate, and good for anybody who's a committed donor with a RIF or RSP, regardless of how old they are. So it is most appropriate on the death of a second spouse, however. So my next example, just checking on how we're doing for time. We're okay, about 50 minutes. So is about the capital dividend account. In fact, this one and the next example after that, they're really both about people with their own companies, and whether they be professional companies or operating organizations. So the capital dividend account is often referred to as the best kept secret. And it's obviously, as I've explained, donated securities can be a great way to save tax. But for clients who have holdcos with investment portfolios within them, there can be an even greater opportunity for a tax efficient charitable donation. So in this scenario, if a donor has securities in their corporation or sufficient pent-up cash reserves with which to pay a tax-free capital dividend, it could really create a meaningful opportunity for those individuals. So let's start with the basics. There's no difference between the treatment of personal donations and the treatment of donations from investment holdcos. There's no capital gains on appreciated securities that are donated in kind. When a corporation makes a donation, it receives a tax deduction versus a tax credit. So that's, I guess, one difference. But the maximum annual of 75% carried forward for 5 years, which I explained, that all remains the same. However, when we consider the role of the capital dividend account, there's an even bigger bump. The capital dividend account, every corporation has one. It doesn't necessarily appear on the balance sheet, but it's a notional account that keeps track of realized capital gains and losses in the corporation. And the shareholder can withdraw the non-taxable portion of that number on a tax-free basis and distribute out to its shareholders. So for corporations with investment portfolios and sufficient cash, the use of the CDA can make for an extremely tax-efficient gift or charitable donation. So, if you assume that you're able to do that, the scenario is that the holdco will receive a charitable tax receipt for the fair market value of the securities. They won't pay any capital gains tax on that. The full capital gain amount will be deemed to have been realized and can be used to increase the value of this capital dividend account, allowing for large tax-free withdrawals from the holding company. Upon the shareholder's death, his estate will pay less tax that would otherwise be the case, because they have, by virtue of having done this, depleted the value. And likewise, the insurance policy strategy works in this case as well. If the insurance policy is taken out on the shareholder's death, then those proceeds can go directly into the CDA account as well and be withdrawn. So that's a complex but not uncommon strategy for people in those scenarios. The next one is about donating preference shares from a private Canadian corporation. So unlike publicly listed securities, gifts of private company shares, they do not enjoy the same favorable tax rules regarding the tax on capital gains. And as I mentioned earlier, there are rather complex rules around, the kind of securities that are being donated, or whether they're qualifying or not. However, there are some accepted rules which allow public charities to receipt for private shares, provided the donor is at arm's length to the charity. So the scenario in this case is really the donor is entrepreneurial and charitable. Their company has the sufficient cash to issue a taxable dividend and has some refund dividend tax on canned balances. The donor is the shareholder, donates redeemable private company preference shares to the charity, which is easy for the charity to value because they're usually at a fixed price, always at a fixed price. And immediately then the company declares a taxable deemed dividend to redeem the shares from the charity, which isn't going to pay any tax on that because the charity is non-taxable. The charity returns the shares from the donor's shares to the company and issues a tax receipt to the donor. The redemption is triggered immediately, and a taxable dividend is paid to the charity to redeem those shares. And in certain cases, there's a refund available to the company for having issued a taxable deemed dividend. So those are more complicated and require a lot more documentation than a standard gift of publicly traded securities. Our protocols internally for accepting shares of this nature are normal donor agreement plus separate deeds of gifts from resolutions from the board of the private company, resolutions confirming their acceptance of the gift and redemption. The share certificates actually physically have to be transferred. It's usually electronic now, but that there has to be an acceptable valuation, which usually with preference shares, as I said, at a fixed value means seeing a historical resolution when those shares were created. If not, then a chartered business evaluation is required. And then, of course, the cash. Now, it doesn't have to be necessarily a check for redemption value, but it does have to be, there does have to be a redemption schedule so that the charity can convert those shares to cash over, in our case, the maximum we have ever accepted for is 15-year redemption period. And that was on a very large gift. So, and suffice it to say lots of legal review has to happen with all of these to ensure that they are documented properly for the protection of yourselves as donors and for the charity who has to be able to defend the tax receipt. So that's really it from me in terms of the scenarios that I wanted to share with you. You know, I mean, I think that it's incumbent upon you, if you're interested in charitable giving, and to speak with your investment and tax and legal professional advisors. And because today it's not really dealing with those professionals is not really about, you know, which mutual fund to buy or which stock to buy. It's really about ways to help you to not only do well, but to be able to do good at the same time. So you can work with your advisors to build more important things that you will be able to look at later and say, this is what my life has been about, and my money has followed the values that I have and my family has.
Absolutely. Nicola, can you speak a little bit to the investment offerings that are available to individuals? Can they have a say, or what type of assets that are being invested into if they have certain things that they would like to avoid?
Sure. Benefaction Foundation has an investment policy. It's an overarching investment policy, and all of our funds pretty much have to adhere to that policy. It's largely a balanced approach with, you know, a 60-40 equity fixed income split. We do allow some alternative assets to be held, and in certain circumstances, we can hold stock that's, you know, donated for a period of time and divest over a longer period, or vice versa, tranche in over a longer period from cash into equities. But for the most part, there is a requirement to have a balanced portfolio that's set by our investment committee of the board. So we do not expressly allow donor-directed trading on our accounts.
Okay.
However, if you are working with your investment advisor, depending on which firm that advisor is with, you know, they can certainly select products and portfolios that would be in keeping with your wishes, but also meet our investment objectives. And that is what happens a lot of the time. You know, depending on some of the firms that we work with regularly, we have a whole list of securities that are pre-approved recommended investment vehicles that essentially you as a donor could just choose from with your investment advisor, because they're already approved by us. And if not, we're always talking to advisors about different scenarios and whether or not we would accept them. So there is a measure of input, but not direct control over investments.
That's great. You know, because it helps to have a relatable experience. I would just like to tell you about, you know, a family that we worked with, and that family, the grandparents had a great deal of wealth that was a windfall, essentially, from years of hard work. And what they did was they had the entire family get involved in the charitable giving part of it. So even the grandkids were involved in helping pick the charity annually. And that just has made such a difference in the involvement of the grandparents, then their children, and then the grandchildren. So the whole family meets twice a year to decide on where the funds should be allocated. And, you know, some of the grandkids are involved in who's going to manage these funds down the road. So it was a great experience for them, and it has made them all more charitable minded. So it's really served a purpose.
I'm really glad that you mentioned that, Hajra, because a lot of the donors that we work with do exactly that. They use this as a way to help to integrate philanthropic sort of sentiments into their family. They have annual meetings, and they oftentimes will let their kids put forward a charity that they want to for the family to select. I mean, maybe not the full portion of their disbursement quota, but certainly a sum. And so it gets kids interested. Many people have given me similar feedback to that. So I concur.
I don't have any additional questions, but if anybody has any questions, we'd be happy to take them now. Okay, so it's quiet, so I will wrap up. Thanks so much, Nicola. I hope that the guests are able to benefit from seeing how they can create a legacy for themselves and their family. Through donor advised funds, it does simplify things for people, so it's a great opportunity. We are happy to refer you to Nicola, and for us to work on planning that would go into creating some legacy for yourselves or your families. I'd like to thank everyone for joining us this evening. I hope you enjoyed it, and I hope you found it to be valuable. The PACE credits will be issued within the next 2 weeks. We'll be taking a little break with regards to the seminars until fall, but we will be back in the fall. Please keep an eye on the TMFD website under the Academy page, where you can also register. And Nicola, I'd like to thank you so much for taking the time to speak with us and our clients. I know that typically you're talking to people like myself and not clients directly, but we do appreciate you taking the time to do this. And thank you to Aaron for running the show, and thank you to our guests. And I'll let Nicola have the last word.
I've just realized now that I see myself on the screen that you can see my moving boxes, and the fact that my hutch behind me is completely empty. So I apologize for that. I should have had come up with some. Anyway, I really enjoyed, I always enjoy being able to chat with people about charitable giving. I hope that I've been able to help some of you think of some new potential opportunities to give back. And it was my absolute pleasure to be invited to speak with you. So thank you very much for having me. I was honored.
Thanks, Nicola. Everyone have a nice evening.
Bye.
Bye-bye.